By the time federal agents raided the Sebin Brewery in Chicago on May 19th, 1924, they expected to find bootleg beer. What they did not expect was a payroll ledger. The document listed 41 names, weekly cash disbursements, and a column labeled simply distribution overhead that accounted for nearly a third of the operation's weekly outflow. The agents photographed every page. Those photographs ended up in court, and that ledger, preserved in federal trial records, is one of the clearest windows we have into what a bootleg empire actually cost to run, week by week. The number at the top of that ledger for the week of May 12th, 1924 was $34,700. That is not revenue, that is operating expenditure. One week, one mid-sized Chicago operation during a period when Prohibition had been running for just over 3 years and the market was still, by the standards of what came later, relatively disorganized. By 1927, when the major Chicago syndicates had rationalized their distribution networks and eliminated most of the independent competition, weekly operating expenditures across the consolidated South Side operation alone were estimated by the Bureau of Internal Revenue at between $400,000 and $600, $100 per month. The gross revenue side of that equation was considerably larger. A bootleg empire in the 1920s was never just a criminal gang with bottles. It was a vertically integrated consumer goods distribution company that happened to operate outside every regulatory framework that governed its legitimate competitors, producing in illegal distilleries and breweries, moving product through a layered network of drivers, warehouses, and corrupt transit points, and selling through a retail network of speakeasies and private clubs that served an American public that had not stopped wanting alcohol simply because Congress told it to. We ran the numbers on how that operation was actually built, department by department, and the structure it reveals is closer to a regional beverage distributor than anything that shows up in the crime dramas. The 18th Amendment to the United States Constitution took effect on January 17th, 1920, prohibiting the manufacture, sale, and transportation of intoxicating liquors. The Volstead Act, passed the previous year, set the enforcement framework and defined the legal threshold. What neither document anticipated was the speed with which an entire parallel industry would assemble itself to serve the demand that the law had failed to eliminate. By 1921, federal prohibition agents estimated that more than 30,000 illegal drinking establishments were operating in New York City alone. The speakeasy was not a rarity, it was an institution. The scale of the opportunity was the first thing any serious operator understood. A bottle of legal beer before Prohibition sold for a nickel at the bar. By 1921, a bottle of comparable quality bootleg beer sold for 25 cents. The markup was not incidental to the business. It was the entire business. And building a structure capable of capturing that markup at scale required the same things any distribution business requires: production capacity, logistics infrastructure, a retail network, and a protection apparatus sophisticated enough to keep all of the above functioning despite sustained regulatory pressure. Start with production, because that is where the capital commitment began. Setting up a brewery capable of producing 500 barrels of beer per week in 1923 required an initial capital outlay of between $15,000 and $40, depending on whether the operator was converting an existing legitimate facility or building from the ground up. Think of it as the equivalent of financing a small regional manufacturing plant. The equipment costs alone, copper vats, fermentation tanks, bottling lines, refrigeration capacity, ran between $8,000 and $22,000. Facility lease or purchase added another $4,000 to $12,000. The first month of ingredient procurement, malt, hops, yeast, corn sugar for the cheaper blends, added between $500 and $6,000. A distillery operation producing whiskey or gin ran considerably higher. A functional distillery capable of producing 200 gallons of spirits per week required between $25,000 and $60,000 in initial setup, with grain and sugar procurement adding $3,000 to $8,000 per month at full production. The capital requirement was not trivial, and it explains why the major bootleg operations of the mid-1920s were not funded by single individuals, but by syndicate structures that pooled capital from multiple investors, each taking a percentage stake in the production capacity in exchange for guaranteed allocation rights to the output. This is, structurally, identical to a private equity consortium funding a new production facility. Several investors, pooled capital, shared risk, allocated returns. The only difference is that no securities attorney was involved in the documentation. Here's the part that most people never think about. The largest single line item in initial setup was not the equipment, it was the bribe. Securing a production site in Chicago or New York in the early 1920s required, at minimum, the cooperation of the local police precinct captain, the ward alderman, and in many cases the county sheriff's office. Documented payments from the 1924 London Thompson machine trial in Chicago show precinct-level payments of between $1, $200, and $2, $500 per month per facility. That is a recurring overhead line, not a one-time cost. It sat on the ledger every single week, as reliably as the malt bill. By 1925, Al Capone's South Side operation had systematized this payment structure to a degree that the Bureau of Internal Revenue later described, in trial preparation documents, as the most sophisticated municipal graft network in American urban history. Capone's organization generated an estimated $75 million in annual revenue, according to historian Lawrence Bergreen's documented reconstruction from court records and IRS files. $75 million across 13 years. That is a protection overhead that no legitimate beverage company has ever had to budget for. The physical infrastructure to move product from brewery to customer was the second major capital commitment, and it is where the operation starts to look genuinely corporate in its architecture. A mid-sized Chicago bootleg operation, running 5 production sites and supplying 300 speakeasies in 1925, maintained a fleet of between 12 and 20 delivery vehicles. The vehicles were almost universally modified. False floors and cargo beds, reinforced suspension to carry weight without visibly sagging. In some documented cases, refrigeration units installed to move beer in summer months without spoilage. Fleet acquisition, including modification costs, ran between $800 and $200 per vehicle, giving a total fleet investment of roughly $10,000 to $44,000 for a mid-sized operation. This is the FedEx problem, transposed to 1925 and made illegal. Last-mile delivery of a perishable consumer product to hundreds of retail customers on a fixed schedule, using a vehicle fleet that had to remain mobile, anonymous, and functional under conditions of active law enforcement pressure. The routing logic that a bootleg distribution manager had to solve every single week was operationally identical to what a regional beverage distributor solves today, with the added complexity that the entire route could be invalidated if a single driver was followed from a warehouse to a delivery point. The documented solution, which shows up across multiple surviving operational records from New York and Chicago, was a hub-and-spoke model with deliberate obfuscation layered into each leg of the journey. Product moved from production facility to a neutral intermediate warehouse, from the warehouse to a secondary transfer point, and from the secondary point to final delivery. Each driver knew only one leg. No single employee had visibility of the complete route. It is, structurally, the same compartmentalized logistics model that classified supply chains use today. Here is the number that makes this concrete. A barrel of beer produced at a Chicago brewery in 1925 cost approximately $4 in raw materials. By the time it reached a speakeasy customer, it had accumulated approximately $3. $20 in distribution, handling, and transfer costs. The brewery gate price charged to the distributor was around €6 per barrel. The speakeasy owner paid between 14 euro and 18 euro per barrel. The bartender sold the contents of that barrel to customers at a price equivalent to roughly €55 to $70 of total retail revenue per barrel. The margin was extraordinary at every level of the chain. The cost of maintaining the chain was equally extraordinary, and it is the cost structure, not the revenue, that most analyses of prohibition economics consistently underestimate. Running the operation required a payroll that would surprise anyone who has only ever seen the romanticized version of this story. The Southside Chicago Syndicate at its peak in 1927 employed, by Bureau of Internal Revenue estimate, between 700 and 1,000 people in operational roles, not counting corrupt officials on the payment schedule. not counting the speakeasy staff who were technically independent operators. 700 to 1,000 direct employees in production, logistics, security, enforcement, financial management, and what the ledgers of the period consistently called public relations, which in practice meant everything from managing newspaper contacts to organizing the charitable donations that kept neighborhood support intact. The weekly payroll for this operation ran between 65 Zulu dollars and 95,000 dollars in direct wages based on surviving ledger fragments analyzed by historian Jonathan Eag in his documented reconstruction of the Capone organization's finances. Scale that to annual terms between $3, $4 million and $4, $9 million per year in direct labor costs for one operation in one city in one era. That is the HR department of a mid-sized regional company, operating entirely in cash, with no W-2 forms, no Social Security deductions, and a termination policy that the labor laws of the period did not cover. The security function deserves specific attention because it is the cost that no legitimate business would recognize on its own books. The enforcement arm of a bootleg operation served three distinct functions that, in a legitimate business, would be covered by three entirely separate departments. First, physical security of production and warehouse facilities, equivalent to a facility's security budget. Second, debt collection from speakeasy operators who fell behind on payment, equivalent to a receivables management function. Third, competitive suppression, which has no legitimate corporate equivalent, but which in financial terms functioned as a market defense expenditure designed to prevent competitors from accessing the same retail customers. The cost of this combined function for a major operation ran between $8,000 and $15,000 per week in direct expenditure covering wages for enforcement personnel, vehicles, weapons maintenance, and the incidental costs of resolving territorial disputes. Historian Michael Lerner's documented analysis of prohibition expenditures between 1924 and 1930 estimates that competitive violence cost the major bootleg syndicates a combined total of between $12 million and $20 million across that 6-year period, including the economic cost of production disruptions caused by raids triggered by rival tip-offs to law enforcement. Violence was not cheap. It was a significant and recurring operating expense that reduced the net margin of every operation that engaged in it. Think of it this way. The protection racket that bootleg operations ran against speakeasy owners, charging a weekly fee for guaranteed supply and freedom from interference, was structurally identical to an insurance policy. The speakeasy owner paid a premium. In exchange, they received guaranteed supply continuity and protection from the kind of trouble that would otherwise shut them down. The bootleg organization was simultaneously the insurer and the primary source of the risk being insured against. Lloyd's of London, which had been underwriting maritime risk since the coffeehouse days of the 17th century, would have recognized the logic immediately, even if the product would have been difficult to place on their books. The money that came in the front door of a speakeasy went through a process before it became usable capital. And that process is where the operation reveals its most sophisticated financial engineering. Cash from retail sales arrived daily, in quantities too large and too irregular to deposit in a bank, without triggering exactly the kind of attention the operation was trying to avoid. The solution, documented in multiple IRS investigations of the period, was a network of cash-intensive legitimate businesses used to absorb and re-emit the revenue in forms that looked like normal commercial activity. Laundries, restaurants, car dealerships, real estate agencies, dog tracks. The term money laundering is a metaphor for making dirty money clean, though popular legend connects it to the practice of using laundry businesses specifically, which handle large volumes of cash from many small customers, to commingle illegal revenue with legitimate receipts until the aggregate became indistinguishable. A mid-sized laundry in Chicago in 1925 might legitimately generate $800 to $1,500 per week in cash receipts. An operator who owned that laundry and needed to clean $12 per week in bootleg revenue would inflate the reported receipts, overpay suppliers for services nominally rendered, and use the resulting paper trail to justify deposits that were, in practice, composed almost entirely of alcohol revenue. The tax paid on the laundered revenue was a real cost, a compliance expense voluntarily incurred to make the remaining capital usable. It was, in effect, a voluntary tax rate accepted in exchange for liquidity. This is where the numbers on the optimistic end of the ledger become genuinely remarkable. A well-run bootleg operation in Chicago at the peak of the market in 1927 to 1928 was generating gross revenue of between $60 million and $100 million per year by IRS reconstruction. Direct costs, including production, distribution, payroll, protection payments, and laundering overhead, consumed between 55 and 65% of gross revenue. Net operating margin before any reinvestment or principal payment on syndicate financing ran between 35 and 45%. For comparison, Anheuser-Busch, the legitimate brewing giant that survived prohibition by pivoting to near beer and malt syrup, reported net margins of between 8 and 14% across the same period, according to its publicly filed annual reports. The bootleg operation generated margins that a Fortune 500 consumer goods company would have found extraordinary, built on the back of a regulatory arbitrage that created an artificial price floor across the entire market. The structure also failed in ways that any analyst reading the balance sheet would have identified years before the end came. The fundamental problem with the bootleg empire's financial architecture was that its most critical cost, the protection payment network, was not actually purchasing a stable operating environment. It was purchasing temporary tolerance that could be withdrawn at any point by a change in political administration, a federal intervention that bypassed local corruption, or a shift in public opinion that made tolerance politically untenable. The Wickersham Commission, appointed by President Herbert Hoover in 1929 and reporting in 1931, documented systematically what the bootleg operators had always known: that the protection network functioned only as long as the political infrastructure that made it work remained intact. When it did not, there was no operational fallback. Al Capone was convicted of tax evasion in October 1931, not of bootlegging, not of the violence that federal investigators had spent years trying to document, but of failing to pay income tax on the revenue that his operation had generated. The IRS approach, led by Special Agent Frank Wilson, reconstructed Capone's income not from confessions or informants, but from financial analysis of spending patterns, cash flows, and the gap between documented expenditure and declared income. The tool that brought down the most powerful bootleg empire in American history was a spreadsheet, an extraordinarily sophisticated one, built by hand across thousands of documents, but a spreadsheet nonetheless. The repeal of Prohibition came on December 5, 1933, with ratification of the 21st Amendment. Within 18 months of repeal, the legitimate brewing industry had recaptured the majority of the market, operating at lower margins but with none of the overhead costs that had made the bootleg operation structurally fragile despite its extraordinary profitability. The competitive advantage of operating outside the regulatory framework evaporated the moment the regulatory framework changed. The assets, the production facilities, the distribution networks, the retail relationships were worth significantly less in a legal market than they had been in an illegal one, because in a legal market they faced genuine competition from capitalized, legitimate operators who did not have to maintain a $75 million bribe schedule to stay in business. That is the lesson the ledger actually teaches. The bootleg empire was not a story of unlimited criminal genius. It was a story of a genuinely sophisticated business operation built on a regulatory arbitrage that was, by definition, temporary. The margins were real. The structure was real. The risk that the entire thing could be legislated out of existence overnight was also real. And no amount of operational excellence changes the fundamental exposure of a business model that depends on a law remaining in place to create the price premium that makes it viable. If the Prohibition ledger just changed the way you think about the economics of regulatory arbitrage, make sure to subscribe and like this video. We open a new ledger every week. Tell us in the comments which criminal empire, smuggling network, or underground economy we should audit next. The books are always open.